This is Professor Hazara again, and this is the continuation of Module 4, the consolidation subsequent to the date of acquisition. Okay, and we're going to continue the example from last time. Now, so let's go to the example. We have this example here, and what we had done last time was I had shown you what the parent does on its own books. This is only on the parent's books to calculate, do the calculations and make the entries for the equity method. And this is all done by the parent. And what it's basically doing using the equity method, it's using the equity method to prepare its financial statements for consolidation. Because in a consolidation, what you're going to do is, you'll see when we get there in the next video, is we reverse what was done in the equity method. We reverse the income account, make it 0. We're going to make the investment account 0 and replace those two things with the income statement and balance sheet of the whole income statement of the sub, whole balance sheet of the sub. Okay, so let's just review what we did last time. Here was our income, our equity method, the cost, goodwill. It was cost 262.5. And we had these amounts, and the write-off amounts were for inventory 12.5, 5 for equipment, and 1.25 for unrecorded patents. Per the text of the problem, the text of the problem is up here. The sub paid 40, earned $40,000 net income. Third line down, earned $40,000 net income and paid dividends of 20. Okay, and so we start with net income and the income from sub calculation. We start with 40 net income times our share of 100%. That seems silly, but in future problems, it's going to be less than 100%. You're going to have to divide that up, so we'll do that later. So our unadjusted share of income was 40. Now, all of these amounts were the write-off amounts, write-down amounts that were brought down by the from the income from sub calculation. Okay, so we had, in essence, for the inventory, we had cost of goods sold, excess cost of goods sold. This was for the equipment. We had some excess depreciation, and for the unrecorded patents, we're going to have some excess amortization. And so our final income from sub was 21.25. The reconciliation of the investment account is always based on the items in the goodwill calculation. They may disappear if they're current assets or liabilities, or they may hang around for a while if they're non-current. Anyway, so it always includes the equity items, common stock and retained earnings. So always start with these. Notice I always start with those equity items, common stock of 150, retained earnings of 15. So I always start with those items. And then in this case, then you add the items that were revalued, inventory, equipment, and unrecorded patents. And notice that, like we did in the other chapter, I reversed the size, 12.5, 25, 25, because they were actually written up. Their fair market value was greater. So that means that from a balance sheet asset liability perspective, those have greater values than they did prior to the acquisition. Okay, and I emphasize that this investment reconciliation was done from a beginning of year, end of year perspective. So the investment account at 1/1/11 was 262.5, and it just makes sense that equals your cost because of the first year acquisition, and your initial investment was for 262.5, and then we had 25, we had 21.5 income from sub, and then the dividends. I think I just put it in there as equal to 20. They're from the text of the problem. So your ending investment balance was 263.75. Now we made 3 equity method journal entries. We debited the investment account for the purchase. This was done, by the way. This entry was made on, I'm going to say 1/1/11 because you bought the thing at 1/1/11. These other 2 entries were done end of the year. Fix that there. So these other 2 entries were done at the year end because you have to, a year has to go by and the subsidiary has to pay dividends and earn and make an income statement for you to be able to make these entries. So that's why we're doing this. This is subsequent to acquisition. So if you add up all the amounts there. Your ending investment balance was 263.75 in the T account, which equals the amount here. Now, all I'm going to do in this video is I'm going to take these three entries here, and we'll call this one entry 1, we'll call this one entry 2, and we'll call this one entry 3. And what I'm going to do is just take those, and keep in mind, these are on P's books, so they're in P's accounting system. They're real entries. You can see the consolidation entries are just working paper entries. So these entries are on P's, come out of P's system, put into P's system, come out, and they impact the financial statements. Okay, so let's go down here and look what we have here. These financial statements are, this column here is, I'll put before here. What I mean by that is this is before the equity method. And this right here is going to be after the equity method. And those two correspond with title, pause financial statements before and after the three equity method entries. Okay, so they're very simple entries. So let's go ahead and start with those entries here. Okay, so the first entry is, in the equity method, is debit the investment account for 262.5 and credit cash for 262.5. So that's just a balance sheet entry. And so we're going to debit the investment account in number 1. I already have the numbers there for 262.5. And we're going to credit cash here, what are we doing, for 262.5 right there. So we don't have a lot of cash left on the balance sheet there. Okay, and entry number 2 is we're just going to debit the investment account. If you look at entry number 2, debit the investment account for 21.25 and credit income from sub for 21.25. So, so in entry number 2, we will debit the investment account for that amount up there for 21.25, and we'll credit income from sub right here. I misplaced that. Let me move this up to there. So we'll credit income from sub for 21.25. 21.25, and in the final entry, we are going to, it's the payment of dividends, so we're going to debit cash for the 20 in dividends because we're being paid dividends. We have no choice there. Debit cash for 20, and then we're going to credit the investment account for the, I'll just already have it marked, so there's entry number 3. That's a credit though. We're going to credit the investment account for the 20 also. Okay, so my debits equal to my credits, and now you can see that we have produced financial statements with a balance in the income from sub account, which we're going to need in order to do a consolidation, and we also have a balance. So I'm going to put that in bold right here. So that's going to be bold right there, and then we also have a balance in our investment account of 253.5. The balance, oh, what am I saying? 263.75. Let's make sure that equals the balance I have up here. It does. 263.75 T account balance and the analysis balance. So we look to be fine in all these accounts. And so we've prepared our financial statements for consolidation here, and So the financial statements we're going to consolidate have a balance of 653.5. Okay, and so what we're going to do, let's just move these over and see what happens. If not, we'll fix it in the next video. So we have financial statements we consolidate are basically, financial statements we consolidate are these right here with a balancing total of 653.5. And so I'm going to make sure is the reason I have these arrows here is I'm just saying that these statements, the 221.25, should be these statements over here. So let's just go ahead and make that equal to that right there. And then I believe all the income statement items balance, all the statement of retained earnings items balance. Let's just make sure that the balance is right in the investment account over here. Okay, the investment account should be 263.75. And with any luck, you'll notice that these statements, the parent made equity, it started with entry balance, financial statements without any equity method entries. You made the equity method entries, and so you've updated your financial statements to be able to do a consolidation at the end of the year. But mainly, you have to show that has to be equal to the income for sub for the year and the investment account of 656. I should take, no, this is fine, of 263.75 should equal the investment account both on your balance sheet just before after the equity method, and should equal your T account balance, and that should also equal your investment account reconciliation balance. Okay, so I'm going to go ahead and stop this video here. In the last video, what we're going to do, so now we're ready to do a consolidation. So in the last video, we're actually going to do a consolidation. And these right here are the consolidation entries. And I'm just going to, these are done on a working paper. I'll emphasize this in the video, next video. And those will be placed in this consolidation. The black box is consolidation. We'll place those in here. I'll show you how to place them in there. But I want you to notice that the consolidation is a work paper. That's what that black box represents. They're work papers. They don't enter, these entries are just a working paper entry. You're going to take what comes out of the parent's accounting system, what comes out of the sub's financial systems, put them on a worksheet, and then we'll do a consolidation. It's just a worksheet. It does not enter. Consolidations do not enter into any of either the parents or sub's financial systems. Anyway, I'm going to end this video now. In the next video, we'll do a consolidation. Okay, thank you very much.